Welcome back to the Funding Blueprint, the show where we dive into the stories and strategies behind successful startups and innovative businesses. Today we have a very special guest joining us, Mike Pestana, a corporate partner at Wilson, Cincinnati, Goodrich, and Rosati in San Francisco. Mike specializes in corporate and securities law, representing both early and late-stage startups throughout their entire life cycle. He's renowned for leading strategic deals, including private financing, secondary transactions, tender offers, recapitalizations, and acquisitions. Mike regularly provides strategic business and legal advice to entrepreneurs and startups as outside general counsel. His clients span the entire startup ecosystem, from one-person companies to unicorns preparing for a public offering. With a focus on clean tech, sustainability, and renewable energy companies, Mike also serves a broad set of clients in other technology verticals. We're thrilled to have him on the show to share his insights and experiences. So without further ado, let's welcome Mike to the show.
Right. Thanks, Abraham. Happy to be here.
Of course, it's our pleasure. So let's kind of dive in here. You'll see that a lot of today's conversation will kind of really focus on the term sheet. So let's start with that. The term sheet could clearly define two critical figures: pre-money valuation, which is your company's worth before the investment, and post-money valuation, which your company's worth after the investment. These numbers are like the DNA of the deal. They determine how much ownership you and the investors get. But here's the twist. Any previous funding using safes or convertible notes can influence your pre-money valuation. So let's kind of dive into this and let's get the details straight. Does the term sheet clearly define both pre-money and post-money valuation? And how do these figures translate into ownership percentages for you and the investors?
Yeah, I mean, I like this question because it is really the DNA of the deal. And I think it's easy for founders and investors too to get focused on one or the other, either the pre-money valuation or the post-money valuation. And to your point, they're both incredibly important. So I think high level, a term sheet will often only have one of the two. So the pre-money might be in there in a set dollar amount that you're raising, or the post-money in a set dollar amount you're raising. Strategically, either could benefit the founders of the company or the investors, depending on what you're trying to get at. So one thing I always recommend is you got to do the pro forma cap table modeling once you see the valuation and the dollars in the round. And it plays into the convertibles too, because there's so many little inputs that are going in when you have safes and convertible notes, which might have different conversion features on top of the valuation. How those interplay together are just critical for the deal and the dilution for the founding team. So pro forma modeling, critical. But I think in terms of which is in the term sheet, probably more often a pre-money valuation is in the term sheet. And that's just the valuation of the company before the dollars are actually invested. The way to think about post-money ownership, though, is the post-money valuation. So pre-money valuation, dollars invested, hopefully equals the post-money valuation. That's not true for every deal, but that's kind of the basic model. And then with respect to the safes and convertible notes, a ton of our clients, obviously almost, I'd say most sort of startups in the ecosystem will have some version of a safe or convertible note from a prior round, at least when they're doing their first price round. And you do often see those included on what's called a pre-closing basis. So you would convert the safe or the note, you would determine the number of shares resulting from that conversion, and then put it onto the cap table as if it's already outstanding before you do the price round. So what the effect of that is the common stockholders, the founding team, the existing people on the cap table are diluted by the conversion of those safes or those convertible notes, but the investor is not in the price round. So when they're setting the pre-money valuation, I think this is essentially the question, is that they're assuming those safes are already converted.
Solid points. Let's move on to liquidation preference, which is something that investors like to normally also include as a part of the term sheet. So this defines how investors get paid if the company exits through a sale or, unfortunately, bankruptcy, which would be every founder's nightmare. It's essentially a safety net for them. Here's the thing, though. Liquidation preference terms can vary. Right? Investors might propose a standard multiple of their investment, which is common. However, there could be an unexpected clauses buried in the legalese that restrict your future options. So Mike, we need to be like financial bloodhounds and kind of sniff out any potential issues. The key question is, what is considered normal liquidation preference terms? And are there any red flags we should be on the lookout for in terms of outlined in the term sheet?
I like that. Financial bloodhounds. It's a good name for a law firm. If I ever leave Wilson, I'll start it. So I think, yeah. So I mean, high level, 1x, what we call a non-participating preferred stock. That's the standard. That's what you probably should see in your first price round. As you sort of scale as a company, you might see more complex liquidation preferences. But what that means is the investor should get the better of 1 times their money back, so their original investment, or, and not and, but or conversion to common stock. So the liquidation preference is their downside protection in the event of a sale that is below the valuation in which they invested at. There's some variation in that. Essentially, that's what would happen. And if you beat the valuation, they're probably converting to common stock, most likely. I say with the caveats that a lot of cap tables can get very complicated, so that's kind of just the initial Series seed round. But if you're a founder and you see anything other than a 1x multiple, if you see 2x, 3x on an initial round of funding, that's very abnormal. Or if you see something where they say it's participating, where they get 1 times their money back, and then they also participate as a common stockholder. That's also very unusual in today's market. Later stage round, down rounds, bridge rounds, you might see these features come into play where an investor says, I want a 3x liquidation preference. I want to participate with the common. Unusual at the early stages. The other thing to keep in mind too is who has the power to waive that liquidation preference. So there's a number of recapitalization transactions, down rounds, kind of funky things you can do where you might be technically triggering the liquidation preference by selling or issuing more than 50% of the voting power of the company to an investor, an effective change of control. But you might want to waive it and not trigger that liquidation preference for a variety of reasons. We typically would see a majority of the preferred stock control that vote, but occasionally you'll see lead investors say, well, I want a blocking right on top of that. So majority of investors plus your lead investor. That's not necessarily a bad thing, but it is a more restrictive. So I think also paying attention to a term which is usually defined as deemed liquidation event and who has the power to waive that is important for the liquidation preference.
Interesting points. Let's move on to board of directors for a second, because I think that's something that's also worth mentioning. Early stage startup companies navigate a crucial stage in setting up their governance structure, and the board of directors really plays a vital role. The term sheet, which is a non-binding agreement, it outlines the key investment terms, and that can sometimes touch upon board composition. Now, this can really spark a couple questions, right? How many seats will investors hold on the board? And are there any special voting rights granted to these investor-appointed directors?
Yeah, it's definitely in the term sheet, and if it's not, it should be added. So there are occasionally you get term sheets where they kind of kick the can. They say, we'll figure out the board during the long form documents. I think to your point, it's critical to figure it out at the term sheet stage. So I think good sort of high level rules are, if it's your first price round, you probably don't want to go over 3 members on the board. And if you're a founding team, you're concerned about control of the board, mostly at every stage of of your life cycle. So if you have a 3-person board, you're hoping that 2 of those directors are designated by the common. 1 would be your lead investor. That's the most common setup. Another common setup is 1 common director, 1 preferred director, that's your lead investor, and 1 what we call a mutual or independent director that's designated by both the lead investor and the common stockholders. That's a little more investor favorable, but also not an uncommon setup. Once you scale to sort of a Series A, Series B round, you're probably looking at a 5-person board. You might have more than 1 lead investor now from different rounds on the board, so perhaps 2 directors filling those seats, maybe 2 from the common or the founding team, and then 1 independent. The independent becomes more critical too as you scale. For one, just from a practical perspective, it's helpful to have industry experts on the board who are non-investors or otherwise affiliated with the founding team. They can add a lot of strategic value to the company. And from a legal perspective, you might be taking votes where you need a disinterested party, and that mutual director can help you. So it can be a good thing. Now, that said, the disinterested director doesn't necessarily need to be elected by the preferred and the common, the founding, and the investors voting together. You could have that mutual just designated by the founding team, for example. That would maintain control of the board with the founding team as opposed to sort of leaning it towards the investors or giving the founding team less control. So I think the critical thing for founders is, how do I maintain control over the rounds of funding in a way that investors are going to accept? most likely through your Series A, perhaps Series B, the founding team should maintain majority control of the board. Sometime between B and C rounds, as you scale, that's usually when that switch happens. And it's a natural switch. Your cap table gets larger. The needs of the company in terms of the number of people managing the business and the number of people on the board just expands naturally, and that's fine. But from a founding perspective, you want to make sure that you maintain control of the board for as long as possible.
Great points. Let's focus on blocking rights for a second. When negotiating with investors, it's crucial to understand the various clauses and provisions that can significantly impact the control and the direction of the startup. One such provision is the blocking right, which gives investors the power to veto certain company decisions. This can range from approving budgets and strategic plans to making significant business changes. Now let's kind of explore this idea further, These give investors the power to kind of veto certain company decisions. But does the term sheet include any blocking rights? And if so, on what matters? And should you consider granting any blocking rights? And if so, under what circumstances?
Yeah, I mean, I think you're right. I mean, it should be in the term sheet. This is one of those other critical terms. And there's essentially two categories. You have your stockholder blocking rights, which are hopefully controlled by a majority of your preferred stockholders, so a majority of your investors, voting on a basis of how many shares they own. So if you invest more, you have a greater voting percentage. And then the other category is preferred director blocking rights. That's a blocking right held by your director elected by probably your lead investor. Both you might see in term sheets, and the latter, the preferred director rights, were in the last year or two, sort of post-COVID era, we're seeing a lot more of those creep into term sheets. In general, the stockholder blocking rights are going to affect the most material transactions the company does. So things like a sale of the company, the ability to issue more preferred stock, which is effectively a block on a financing. You might have insider transactions being subject to a stockholder vote. That's a transaction between the company and an officer or director. So for example, the founding team member owns a piece of real estate, you want to lease it for the company's use, that's an insider transaction that would be approved by the stockholders. There's sort of your basic subset of those rights from the stockholder side of things, which I think at a high level is going to be future financing, a sale of the company, and sort of adverse changes to the round of preferred stock you're issuing. I think that category, you can't really get away from those. It's pretty hard in venture financing not to grant those rights. Then there's probably 5, 6, maybe even 10 other rights that are a little more flexible. Some of these companies won't care about at all. So one common right that kind of gets dismissed is the issuance of tokens. So nowadays, at least this year, people aren't too concerned about issuing tokens anymore. So subjecting that to a stockholder vote, I think most founding teams don't really care. But there are certain businesses where, for example, the issuance of debt is critical. You may have warehouse facilities, you may have non-traditional sort of, maybe a fintech company with needs to fund a part of their operations with debt from an outside provider. You may or may not want that to be subject to a stockholder vote, depending on how restrictive those terms are. So some of those things with the stockholder voting is a little more bespoke. Now switching to the preferred director voting, these are usually more in the weeds, but also less critical. So things like budgeting, like you mentioned, setting the compensation for your executive officers, changing the principal line of business of the company, those things are often subject to the preferred director vote. In practice, we see that being less of an issue, especially the early stages. Typically, if you're a 3-person board, 1 preferred director, usually unanimous voting on most things, especially if you're talking about like a year or two after your first round of funding. If you find your board is contentious in that first year, I think you have to look back and say, do we need to reevaluate our investors and the company, what we're doing? But it's not unusual to give away those terms. I think another philosophical distinction is that the preferred director is subject to the fiduciary duty qualifications that any other director is going to be subject to. So when they take a vote and they set executive compensation, they have to do what's in the best interest of all stockholders. They can't just sort of favor those who appointed them, so the lead investor. So preferred director votes are important. Those blocking rights can come into play, but they are subject to ordinary fiduciary duties. In contrast, a stockholder vote is not. A stockholder can act in their own interest. And And this subtlety can come up when you're thinking about really material transactions. So I guess I'd say that there are short lists and long lists of both those blocking rights. Shorter lists should apply at the earlier stages, longer lists as you sort of scale as a company, but also think about who should have the power. There's basically three buckets. There's your stockholders, there's your directors, and there's your management team. And we're talking about two of the buckets right now. And in terms of managing a business, who should control which rights? Sometimes that's obvious from the form documents you're probably using for your financing. And for different businesses, that may not be so obvious. For example, the debt blocking right may belong in a separate bucket, depending on how your company uses debt.
Solid points. Let's kind of move forward to anti-dilution for a second. 'Cause I think it's a big one that you want to talk about in general, because many founders that I speak with actually have no idea what this is, and I'm sure that your insights would be awesome on this. So, when raising capital for, a founder's company or startup, understanding the intricacies of the term sheet is vital. But one key provision to be aware of is the anti-dilution protection clause. And now this mechanism kind of safeguards investors' ownership stake, even if the company raises future capital at a lower valuation, which is commonly referred to as a down round. But anti-dilution protection ensures that the investor's equity percentage is maintained despite the fact that they had a decrease in the company's valuation. Now, Mike, does the term sheet offer anti-dilution protection, and is it really a requirement, or can you negotiate alternative terms?
Yeah, it is one of those more esoteric terms that gets in there, and oftentimes it's just one word. It just says, ordinary anti-dilution rights or broad-based weighted average anti-dilution rights. And I think most founding teams will Google it or they'll chat GPT and they'll try to figure out what that is. It's not very straightforward. So first principle, it is common. I'd say, essentially every venture financing has what's called broad-based weighted average anti-dilution protection. This has become the market standard, and it shouldn't scare founders. It should just kind of be the off-the-shelf go-to term. But to your point, what that means is if you do a down round, which is going to be defined as issuing preferred stock at a price per share below the previous round, so you issue at 50 cents instead of $1, the conversion price, which means the way the ratio of preferred stock to common stock is determined, is going to decrease. So when you issue preferred stock, you typically have a 1-to-1 conversion ratio, meaning every share of preferred stock is convertible into 1 share of common stock, just equal. The conversion mechanism changes when you hit the anti-dilution trigger, so you do your down round. And when you do your down round, you change the ratio of how the preferred stock is converted into common. So the background calculation is a little bit convoluted, but essentially the more shares of stock you issue at the lower price, the more heavily the anti-dilution trigger affects the conversion price. So if you were to issue 1 share at a lower price, it might have 0 effect when you take into account rounding on the price per share. But if you were to issue, $10 million and you previously raised $10 million, that's going to have a pretty large effect on that conversion ratio. And where this matters is when you sell your company, let's say you beat your liquidation preference, all the preferred stock is going to convert into common stock. Now, originally that's a 1-to-1 conversion, but if you've hit the anti-dilution trigger in the past, it's going to be a greater number of common stock produced for each share of preferred stock. It certainly matters to founders, and it gets triggered in the down round scenario, but a few things you can think about to mitigate that risk. One, if you need to do a down round, raise as little money as you can. That's going to minimize the effect of the anti-dilution trigger. The trigger is also waivable by what is typically a majority of the preferred stock. Sometimes it's an individual series basis, which is another thing to look out for as you do multiple rounds of funding. A lot of times investors will say, my particular round of investors, your Series A or Series B, I want to have a majority of that round waive anti-dilution trigger. That is more restrictive and becomes more challenging if you have to do a down round, say, at a Series C or a Series D level. So majority preferred is great if you can get that term in there. But oftentimes in down rounds, it does get waived because for whatever reason, the investors sort of agree that we don't want to trigger it. It's going to have too dilutive effect on the common stock or the founding team. That's not what we want. But if you're a founder and you're looking at term sheet with anti-dilution, I think you should probably think this is ordinary. As long as it's broad-based weighted average, I'm not going to be able to negotiate out of it. The only thing I might be able to do in the margin is potentially one of two things. One, you can try to exclude certain transactions from it. So For example, you could say that a transaction approved by a majority of the preferred stockholders will not trigger the anti-dilution trigger. If you have a very large cap table, that can be really helpful. In addition to that, you could have sort of the majority of the board waive certain things. So if you have a preferred director, often they'll want to see majority of the board plus the preferred director waiving individual transactions that would otherwise trigger the anti-dilution provision. So, for example, the issuance of equity to a landlord or the issuance of equity to a third-party service provider, an OEM provider, that sort of thing you could have either subject to majority of the board, which if you're early on might just be the founding team, or majority of the board plus your preferred director. Those subtleties will matter in a down round. So when you're thinking about the anti-dilution right, the takeaway is don't be so focused on whether we include anti-dilution or not. Think about in the margins how this would actually come into play and who has the controlling rights to waive it if you need to.
Makes sense. Makes sense. Thanks for sharing. Let's chat about pro rata rights for a second. And I think that's another very pressing matter to talk about. When negotiating a term sheet, right, it's crucial to kind of pay attention to certain investor rights that can significantly influence your startup's future fundraising and information transparency. And many of them we've already discussed. But two key rights to understand are pro rata rights and information rights. Pro rata rights enable investors to maintain their ownership percentage in subsequent funding rounds, ensuring that they can participate in future growth and avoid dilution. On the other hand, information rights, they guarantee that investors have access to specific company information, which helps them stay informed about the company's performance and the strategic decisions. So given the importance of these rights, it's essential to thoroughly understand their implications and negotiate them effectively. So Mike, are pro rata rights and information rights typically required or are they negotiable?
Yeah, I think at a high level they're required. If you're talking about an ordinary kind of institutional VC, they're going to say, they definitely need basic information rights, which essentially constitutes financial statements. They'll probably have a list of things like annual financials, quarterly financials, maybe even monthly financials. And they'll have a catch-all block at the end about inspection rights, meaning they can kind of, with enough notice and reasonable qualifiers, they can show up at the company and investigate the books and records, which sort of mirrors a statutory right in Delaware anyway. So it's not much of a give. This is another one of those where you're going to give information rights up to some extent, but how detailed those rights are might matter. Now some companies heavily negotiate information rights and then they don't follow them at all and nobody enforces them. That might be a large minority of companies do that. But assuming you're going to follow them strictly, the first thing you're going to worry about is audited versus unaudited financials. Early stage companies really shouldn't have audited financials, especially the first price round. That often gets struck if that's sort of in the term sheet. The next thing you might worry about is the amount of reporting. So is it quarterly? Is it monthly? The details of the reporting are generally the same. It's sort of your basic financial metrics that you're probably going to have on hand anyway. But it does take away time from operating the business to try to prepare those things. Most founding teams don't have sort of full-time devoted CFO at a Series Seed level. So it's the founding team themselves that has to kind of create these financial statements, and the cadence of how they're disclosed can matter in terms of taking away time from the business. So I think there's a reasonable way that at the earlier stages, at least, you can push back and say, yes, we need information rights, but we want to limit those. The other factor, too, is what kind of investor you have. So impact investors, I do a lot with climate and clean tech kind of companies. ESG reporting is important for their LPs. And so you might see in a side letter sort of specific ESG type reporting where they may have their own forms, they may have separate things that they need to see on a monthly, quarterly, annual basis. And you might not be able to negotiate that. That might be something built into their partnership agreement for the fund itself, saying they have to have these rights. So it's not so much, if you see that, it's not so much sort of pushing back against them, it's just understanding them and understanding how you're going to comply with those information rights. Another sort of high-level point, philosophically, you generally want at least your lead investors really in tune with the business and understanding what's going on. It's good for an investor relations perspective. They're going to need to help you raise funds in the future. You want them on your team. They might be able to help you commercially if they understand what's happening. So it's to the company's benefit a lot of times to have information rights, even if they seem a little bit burdensome. I also find that some founding teams would not otherwise be disciplined about financial reporting if they didn't have these rights. So from an investor perspective, there's a pretty strong reason for them to request the information rights. Now, the other right, the pro rata right, which is somewhat interrelated, most of the time it's limited to the lead investor and a hand-selected sort of major investors. It's pretty rare that everybody gets a separate pro rata right into future rounds. That said, if you do give a pro rata right to everybody, this is another one of those where control matters. So if everyone has a pro rata right, but the waiver of that pro rata right is controlled by, let's say, a majority of your investors, which is not uncommon, then really the major investors who control the pro rata right, the majority of that class, they're the ones with the pro rata right. They're the ones who decide whether it gets triggered or not. You may even have scenarios, and if you look in sort of the standard, this would be in your investor rights agreement in the NBCA style forms, you'll see there's a parenthetical very deep in the amendment provision that says, even if the pro rata right gets waived, and even if a major investor has a pro rata right who waived the right for everybody else, participates in the financing. So they say, no one else gets it, but I still get it. And those investors participate in the financing, it doesn't trigger a pro rata right for anybody else. So the off-the-shelf provision basically says that your lead investor or whoever controls the majority of the preferred stock controls who gets the pro rata right, including the lead investor. So that is to say that giving a pro rata right has, it's a very standard provision, but the control rights over that, who actually controls whether the pro rata right gets waived, is really where the negotiation is. Similarly, if you have a small investor, maybe they're important strategically, they might have a side letter where they say, I get my pro rata right no matter what. You can't waive it. That's something to really think about, because if you give it to one investor, other investors might ask for the same deal. You have to think about, can I take a position where they get this special right above somebody else because they have some strategic importance to the company above somebody else? And even if they do, can you justify that to another investor who thinks they're also strategically important? So pro rata rights are standard. You're going to see them in every deal. But the control of the pro rata rights will vary from deal to deal.
Awesome. I have to say, I've learned a lot in just a short amount of time, and I'm sure our community will stand to benefit a lot from that. So I'd really like to thank you for taking the time to kind of walk us through the entirety of really the term sheet, because these are really the main points ultimately, and these are the things to look out for. So thank you for taking your time. And that's really a wrap on today's episode. So we hope that you gained valuable insights into the intricacies of the term sheet and the critical rights that can shape the future of your startup. A special thanks to our guest Mike Pestana for sharing his expertise and shedding light on these essential topics. If you want to learn more about Mike and the incredible work that he's doing at WSGR, please be sure to check out their website and social media links in the show notes. Don't forget to subscribe to our podcast for more expert advice and startup stories. Until next time.